For years, the conversation around XRP was dominated by retail hype, court dates, and the relentless hope for a community that refused to let go. But as we step into January 2026, the noise of the past has been replaced by something far more profound: the sound of a global financial machine clicking into gear. Now, if you've clicked on this video because you felt the ground shifting beneath the financial system, you were right. We are no longer talking about a speculative coin. We are witnessing the activation of a structural utility. Now, while the broader crypto market has spent the last month grappling with volatility, XRP has carved out its own path, recently outperforming both Bitcoin and Ethereum in the opening week of the year. Now, this isn't just a random pump. It is a result of a calculated institutional migration. Since the launch of the spot ETFs in late 2025, we have seen an unprecedented streak of inflows, over 43 consecutive days without a single dollar leaving the fund. And while Bitcoin ETFs saw billions in selling pressure, XRP's funds have quietly crossed the at least $1.4 billion mark in total assets. This is the Great Reset in real time, the transition from meme-tier speculation to a locked institutional supply. In the first week of 2026, XRP surged 27%, dwarfing Bitcoin's 7% gain. While Ethereum remained range-bound, institutional capital pivoted, driving over $40 million into XRP ETFs in just 7 days, signaling a massive rotation of wealth into the XRP ledger ecosystem. The narrative has fundamentally evolved. We are moving away from the era of when moon and into the era of necessary utility. Industry leaders are now pointing to a specific framework that separates XRP from every other asset in the space. A framework that suggests its role in the future of finance is no longer a matter of if, but is a matter of operational necessity. Jake Claver, CEO of digital Ascension Group, recently stated that XRP already satisfies every requirement necessary to operate inside the global financial system. He argues that for XRP to grow into the next-gen financial infrastructure, it must tick 4 specific boxes: price stability, network reliability, transactional volume, and institutional support. Current market data reveals a supply-demand squeeze. Exchange reserves have plummeted to a 7-year low of 1.6 billion tokens. With ETFs removing 1% of the circulating supply every month, the liquid float is evaporating just as institutional mandates are forced to execute. Looking at these numbers, I can't help but feel like we have reached a point of no return. The global reset isn't a single event. It is a series of dominoes, and right now, the first domino, the institutional unlocking of XRP, has already fallen. The global reset is not a conspiracy theory. It is a technical requirement. You cannot run a multi-trillion-dollar economy on a network that breaks under stress or a currency that lacks liquidity. Jake Claver, the CEO of digital Ascension Group, recently laid out a blueprint that fundamentally changes how we view this asset. He argues that for XRP to transition from a speculative token to the bedrock of the next generational financial infrastructure, well, it must satisfy 4 distinct criteria. Now, these are not just check boxes. They are the structural guardrails of the new world. To support institutional-grade settlement, XRP must maintain a tight price floor between $1.80 and $2.20, consistently process $3 billion to $7 billion in daily volume, and leverage its track record of 13 years of zero downtime reliability alongside 300 global banking partnerships. Price stability might seem counterintuitive to an investor looking for a moonshot, but for a global bank, stability is the price of admission. They are not looking for a lottery ticket here. They are looking for a predictable bridge. Now, this is why the current consolidation near the $2 mark is arguably more bullish than a sudden, unstable spike. Now, Claver's thesis, it suggests that the truth of the reset is that the asset is being preconditioned. Now, we are watching the engineering of a tool, not just the trading of a coin. Jake Claver stated that institutions are relatively indifferent to the exact price level at which they obtain exposure if they are convinced that the strategic direction. Now, they are perfectly happy to be buying XRP at $100 or $1,000 or even $10,000 because they know its role is necessary rather than optional. This shift in mindset, from price entry to utility access, is the fundamental difference between the retail and institutional investor. The institutions realize that the value of the network grows exponentially with the volume of the transactions moving through it. As more corridors open, the inherent demand of the asset becomes programmed. It is no longer about social media hype, it is about the cold, hard math of settlement. Now, the XRP ledger processes transactions with 3 to 5 second finality, handling 1,500 transactions per second without the energy drain of traditional mining. This efficiency, it allows for a consistent daily volume of 2 million on-chain transactions, providing the throughput necessary for the $27 trillion of capital currently trapped in outdated banking rails. When we look at the XRP ledger today, we are not just looking at a faster blockchain. We are looking at a system that is designed to liberate dead capital. The sheer efficiency of this network is what makes the 1,700 non-disclosure agreements that Ripple has signed so significant. They are not waiting for the technology to become ready. They are waiting for the old system to be deactivated so the new one can take its place. For years, the XRP army was the most vocal group in the crypto space, fueled by a belief that the massive price explosion was just one court ruling away. They were right about the asset's potential, but they were wrong about who would drive the final ascent. The era of retail hype driving the price of XRP is effectively over. We have now entered a phase where the price action is being dictated by structural mandates and institutional accumulation. Now, looking at the data from the past 12 months, it becomes clear that the weak hands have been shaken out, replaced by massive entities that don't trade on emotion. Data from early 2026, it shows a dramatic shift in wallet concentration. Retail addresses holding less than 10,000 XRP have decreased by 18%, while whale addresses, those holding more than 1 million tokens, have surged by 24%, now controlling nearly 70% of the total circulating supply. This transition is the hallmark of a maturing asset. In the early days, XRP was a speculative bet. Today, it is a strategic reserve. The narrative has shifted from get-rich-quick to systemic necessity. Now, I've often said that the true Great Reset would be the moment when the public stops caring about an asset right before the big players start making it essential. We are currently in that window. While the average investor is distracted by the latest AI token or meme coin, the plumbing of the global financial system is being quietly rewired with XRP at its center. A senior analyst at a major New York investment bank recently noted that they are no longer looking at XRP as a tradable currency, but as a protocol layer for value. Now, he stated that their objective is not to sell at a 20% profit, but to secure enough liquidity to facilitate cross-border settlement for their corporate clients over the next decade. And this is what retail often misses. The big money isn't looking for an exit strategy. They are looking for an entry into the new financial paradigm. Now, they are building a wall of money that retail simply cannot compete with. When the liquidity is sucked out of the exchanges and moved into private vaults and institutional custody, the float disappears. Now, this is how you get a supply shock that has nothing to do with social media sentiment. Institutional volume on the XRP ledger has grown by 400% year over year. In 2025, over 60% of transactional volume originated from Ripple's on-demand liquidity corridors. By January 2026, that figure has surpassed 85%, leaving less than 15% for speculative retail trading. The retail narrative died because the scale of the game became too large for individuals to move the needle. This is actually the most bullish signal possible. It means that the asset has graduated. It is no longer a toy, it is a tool, and tools are valued by their utility, not by their popularity. The arrival of spot XRP ETFs wasn't just a regulatory milestone, it was the construction of a physical barrier around the available supply. In the world of institutional finance, an ETF acts as a black hole for liquidity. Once the big money enters these products, it rarely leaves, and as of January 2026, we are witnessing a phenomenon that has left traditional market analysts stunned. Over 43 consecutive days of zero outflows. This is the $1.37 billion wall. It represents a massive amount of XRP that has been pulled off the open market and locked behind an institutional shield, effectively creating a supply-side crisis for anyone trying to buy in late. The total assets under management for XRP spot ETFs have climbed to $1.37 billion since their inception. More importantly though, the velocity of the underlying asset has dropped significantly within these funds, as 92% of institutional shares are held by long-term mandates rather than active traders. However, we must address the reality of this transition. While the narrative is overwhelmingly bullish, navigating the crypto market involves inherent risk. None of this is financial advice, and the volatility of digital assets means that even the most necessary utility can experience sharp price corrections. Diversification and risk management remain the only true defenses against market unpredictability. But for those watching this, watching the kind of wall, the signal is kind of clear. The institutions are building a floor. They aren't just buying the asset, they are removing it from the reach of the public. A leading fund manager at Bitwise recently remarked that the lack of outflows in the XRP ETF suggests that the current holders are not speculators, but actually strategic allocators. Now, he noted that these investors view XRP as a fundamental piece of the digital asset strategy, in simply similar to how they view physical gold or land. This shield effect changes the math of the Great Reset. In previous cycles, a price surge was always met by a wave of retail selling that crashed the market. But you cannot panic sell an institutional mandate. These funds operate on quarterly rebalancing and long-term horizons. By locking up over $1 billion worth of XRP, these ETFs have created a supply and demand imbalance that is now reaching a breaking point. When the global banking rails finally switch over to the XRP ledger, well, they will be fighting over a very small fraction of the liquidity that remains outside of these institutional vaults. Exchange liquidity for XRP has hit critical threshold, with only 4% of the total supply currently available for immediate purchase across all top-tier exchanges. In contrast, institutional demand through OTC desks has increased by 300% in the last quarter alone, bypassing the public markets entirely. I look at this data and I see a programmed squeeze. The institutions didn't just show up at the party, they bought the building and are now deciding who gets to stay. The reset is about control, and the first step of control is ensuring that you own the pipes before the water starts flowing. While the wall of money is being built around the ETFs, a different kind of foundation is being laid in Washington, D.C. For years, the primary headwind for XRP was regulatory uncertainty, the grey area that kept the largest US banks on the sidelines. But as we move through January 2026, that fog has finally lifted. The Clarity Act, recently moved through Senate markup phase, has provided the definitive legal framework that the industry has been demanding for over a decade. It's no longer a debate about whether XRP is a security. It is now legally codified as a digital payments asset. The Clarity Act of 2026 establishes a clear three-tier classification for digital assets. XRP has officially been categorized as Tier 1 utility asset, a designation that allows national banks to hold the token on their balance sheets for liquidity purposes without incurring punitive capital charges. This legislative shift is the true green light. It is the difference between a bank experimenting with RippleNet and a bank integrating XRP into its core settlement architecture. Now, when I look at the timing of the Senate markup, it doesn't just feel accidental. It aligns perfectly with the rollout of the new ISO 20022 standards across the global banking sector. The global reset requires a bridge that is legally compliant in every major jurisdiction, and right now, XRP is the only asset that has been through the fire and come out with a legislative stamp of approval. A key sponsor of the Clarity Act recently remarked during the Senate floor debate that the United States can no longer afford to let the plumbing of the global economy rely on 50-year-old technology. He stated that by providing legal certainty to assets like XRP, the US is securing its place in the next generation of value transfer. This isn't just about the US though. The Clarity Act has created a regulatory arbitrage in reverse. Now that the US has provided a framework, other G20 nations are racing to harmonize their own rules to avoid losing capital to American markets. This creates a global race to the top for liquidity. Now, for the first time, we are seeing the personal views of the regulators align with the reality of the technology. They recognize and realize that the reset is inevitable, and they would rather it happen on a regulated, transparent ledger like the XRP ledger than in an opaque private system. Since the Clarity Act's progression, institutional onboarding requests for the XRP ledger have increased by 600%. Over 45 US-based regional banks have already begun public pilots for cross-border settlement targeting a combined annual transaction volume of $800 billion by the end of 2026. We are watching the legal moat being dug. Once these banks integrate their systems with the ledger under the protection of the Clarity Act, the switching costs become astronomical. They aren't going to move their infrastructure again for another 40 or so years. This is how you achieve prominence in a financial system. The reset isn't just a moment in time. It is the locking of the new rails into the bedrock of the law. The greatest inefficiency in the history of global finance is the ghost system that most people have never heard of: Nostro and Vostro accounts. Currently, the world's banking giants are forced to park an estimated $27 trillion in pre-funded accounts across the globe, just to ensure that when you send a payment, the money is actually there to settle. This is dead capital. Trillions of dollars sitting idle, doing nothing for the economy simply because the current SWIFT system is too slow to settle in real time. Now, the Great Reset is, at its core, the liberation of this $27 trillion, and XRP is the key that unlocks the vault. Traditional cross-border settlement requires 2 to 5 days and costs an average of 7% in fees due to the $27 trillion locked in pre-funding accounts. Now, by using XRP as a bridge, institutions can settle in 3 seconds for less than a penny, potentially freeing up nearly $30 trillion for global lending and investment. When we talk about the truth of XRP's value, it isn't found in a chart pattern. It is found in the mathematics of efficiency. And if you are a bank, Why would you leave $1 billion sitting in a dormant account in London or Tokyo when you could actually hold a neutral digital asset that settles instantly? This is the pivot that David Schwartz has been architecting for over a decade. We are moving from a world of pre-funded friction to a world of on-demand liquidity. Now, for the first time, banks are realizing that the cost of not using XRP is higher than the risk of adopting it. David Schwartz, Ripple's CTO Emeritus, recently explained that while institutions have historically preferred off-chain settlement, that trend is actually now changing. Right? He stated that institutions are starting to see the massive benefits of moving on-chain to leverage the speed of transparency of the XRP ledger, turning what was once a slow manual process into a real-time utility. This shift is why we are seeing a sudden surge in RippleNet activity. It's not just about small remittances anymore. We are seeing Tier 1 banks in the Asian Pacific region and Europe beginning to migrate their core settlement corridors. They aren't doing it because they like the technology. They are doing it because the Great Reset demands a more efficient use of capital in a high interest rate environment. In 2026, liquidity is the most expensive commodity in the world, and XRP is the most efficient way to move it. In early 2026, Ripple's on-demand liquidity has expanded to over 55 countries, with 40% of RippleNet's 300 banking partners now actively using XRP for settlement. This network growth has resulted in a 32% year-over-year increase in ODL volume, processing over $1.3 trillion in a single quarter. Looking at the sheer scale of this migration, I cannot help but feel that the bridge is already being built, and we are just waiting for the final traffic to be diverted. The Nostro-Vostro system is a relic of the 19th century. XRP is the infrastructure of the 21st. Once the dam breaks and that $27 trillion starts looking for a new home, the liquidity requirements for the XRP ledger will be unlike anything that we have ever seen in the history of finance. As the global financial architecture transitions to this new standard, the risk of the reset becomes a matter of survival. Now, one of the biggest mistakes that retail investors make is assuming that the path to the new system will be smooth, straight line. In reality, the migration of trillions of dollars into a digital-first infrastructure will actually be quite chaotic. This is why the world's most sophisticated traders and institutional desks do not rely on a single point of failure. They use what we would call a redundancy strategy. It is a professional-grade approach to risk management and ensures that you are never locked out of your liquidity when the market moves the fastest. Historical data shows that during a high volatility event, 68% of major crypto exchanges experience severe service disruptions or withdrawal delays. Now, by distributing assets across 3 or more high liquidity platforms, institutional traders reduce their platform risk from a 100% single point of failure to less than 5%. Now, I've always maintained that the truth of this market is that the tech is solid, but the gateway can be fragile. Now, if you are serious about holding XRP for the long term, then you have to think more like a bank. See, banks don't keep all of their cash in one vault. They use multiple correspondents and various settlement rails. Now, for individual investors, this means using a suite of the world's leading exchanges to ensure that you always have a way to execute. Whether it is Bybit, Kraken, or Binance, having active verified accounts across the board is your insurance policy against the inevitable technical glitches that happen during the global reset. A leading risk officer at a Tier 1 crypto brokerage recently noted that redundancy is not just an option, it is a mandate. He stated that for their high net worth clients, they never allow more than 25% of an asset class to sit on a single exchange or under a single custodian, regardless of how reputable they are. Now, this isn't about fear, it is about professional grade positioning. Now, we are entering a world and a period where access will be more valuable than the price. So if the price of XRP hits a new all-time high, but you cannot access your exchange to manage your position, well, the price simply doesn't matter. By utilizing the affiliate links provided on my website, which you'll find a link for in the description, you aren't just supporting the channel here, you are building your own institutional grade redundancy. Now you are ensuring that when the reset goes live, you have the keys to every gate in the city. A study of the 2024 and 2025 market cycles revealed that users with accounts on multiple exchanges were able to capitalize on arbitrage opportunities 4 times more often than a single exchange user, capturing an average of 12% more value during sudden supply-side liquidity shocks. You see, the smart money isn't just buying XRP, they are buying infrastructure. They are setting up multiple on-ramps and off-ramps, securing hardware wallets and testing their exit and entry routes before the peak of the cycle. The reset will happen in a blink of an eye. Those who are prepared for a redundancy strategy will be the ones who actually profit from the transition, while everyone else will be left staring at service unavailable screens. If you only look at the news headlines, then you are seeing less than 10% of the total picture. The true scale of the global reset is hidden beneath a layer of non-disclosure agreements so fast it effectively creates 2 different realities. The public market, where retail traders will battle over a few cents, and the private corridors, where the future of the world's wealth is being negotiated. Now, Jake Claver recently pointed to a staggering figure that should stop every investor in their tracks. Ripple is reportedly sitting on over 1,700 signed NDAs. Now, these are not just with small fintech startups. They actually represent the domino theory in its final stage, a silent alignment of central banks, Fortune 500 companies, and global payment networks. As of January 2026, RippleNet's reach has expanded to over 55 countries and 300 plus financial institutions. The network now facilitates over $15 billion in monthly volume, with 40% of those partners, including major Tier 1 banks, actively utilizing XRP for real-time on-demand liquidity settlement. The truth that many fail to grasp is that a global transition of this kind of magnitude, it cannot be broadcast in real time. You don't announce you are replacing the world's reserve rails while the old rails are still carrying the weight of the global economy. You build it in the shadows, you sign the NDAs, you run the pilots, and you wait for the systematic reset button to be pushed. Now, I cannot help but to feel that the current price of XRP is a reflection of the public ignorance, not the institutional value. And while the masses wait for a tweet to confirm the news, the entities managing trillions of dollars have already signed their names on the dotted line. Jake Claver, the CEO of digital Ascension Group, noted that Ripple signed over 1,700 non-disclosure agreements, probably isn't random, right? He argues that these likely cover talks with major players, governments, global banks, and big universities, all laying the groundwork to use the XRP as the backbone of the future markets. This invisible liquidity is what drives the next leg of the cycle. When these NDAs expire or transition into public partnerships, like the recent institutional liquidity framework announced between Ethernorth and Doppler Finance, the market won't have time to react. We saw a glimpse of this on January 8th, the rumors of major infrastructure integrations sending shockwaves through the derivatives market. The institutions aren't just coming, they are already here, and they have spent the last 3 years ensuring that when the public finally wakes up, the supply is already gone. Ripple entered 2026 with a massive strategic advantage, following a late 2025 funding round that valued the company at $40 billion, with nearly $4 billion invested back into the crypto ecosystem, Ripple's balance sheet now provides a structural buffer against market volatility, allowing them to prioritize long-term utility over short-term price action. We are moving into a delivery phase, right? The NDAs are the blueprints, the ETFs are the vaults, and the Clarity Act is the law. The only thing left is the activation. Now, if you are waiting for the all-clear signal from the mainstream media, then you've missed the trade. The reset is a private event with a public outcome. The most significant wealth transfer in history is not happening on public exchanges or through retail applications. It is occurring within the quiet, wood-paneled rooms of family offices, the private wealth management firms that handle the billions of ultra-high net worth individuals. Right? These entities operate on a generational timeline, and their move into XRP represents a profound shift in the asset's status. They are no longer treating it as crypto gamble, but as a wealth insurance policy against the instability of the traditional fiat system. As we enter 2026, the family office framework has become the gold standard for long-term XRP positioning. Surveys of global family offices in early 2026 reveal that 82% now hold digital assets. Specifically, XRP has seen a 500% increase in allocations among these firms, with the average portfolio dedicated to the asset raising from 0.5% to nearly 7% in just 18 months. This shift is driven by the realization that the Great Reset is a mathematical inevitability. When the old system reaches its debt ceiling and the velocity of money stalls, the world will turn to the most liquid, regulated, and efficient bridge available. Now, these families are allocating 5 to 15% of their total portfolios to XRP, not because they want to trade the daily candles, but because they want to own a piece of the future's plumbing. Now, looking at this, I can't help but feel that the truth of the matter is that the wealthy are front-running the very system that they helped build. They are moving their capital into the utility before the door slams shut on the old world. A managing director at a leading Zurich-based family office recently stated that they view XRP as digital infrastructure land. He explained that just as families in the 19th century bought the land where railroads were built, today's generational wealth is buying the digital rails that will carry the next century of global value. If you want to move like the smart money, then you have to educate yourself beyond the headlines. This is where professional-grade resources become essential. For those looking to master the technical and fundamental nuances of this financial paradigm, platforms like Cheeky School offer the deep dive curriculum needed to transition from a retail mindset to an institutional one. By using the link that's in the description and the 50% off code, you are investing in the same kind of knowledge that these family offices pay millions to acquire. Furthermore, our free educational Discord community serves as a digital war room, where you can track these institutional flows in real time alongside like-minded investors. Direct investment from private wealth into XRP-focused investment vehicles reached all-time highs of $950 million in the fourth quarter of 2025. Now, this capital is predominantly sticky, with the average holding period exceeding 5 years, effectively removing billions of tokens from the tradable supply. We are seeing a convergence: the legislative clarity of the Senate, the structural demand from banks, and now the generational accumulation from the world's wealthiest families. The reset is no longer a potential event, it is an active process. The family office framework tells us one thing: the people who have the most to lose have already decided that XRP is where they will find the safety. We have reached the final layer of the global reset, and after examining the institutional 4 boxes, the legislative clarity of the Senate, the quiet accumulation of the world's wealthiest families, one question remains. What is the actual value of an asset that powers the entire world? For years, the community have debated the $10,000 XRP theory, and while that number sounds like science fiction to the average day trader, it becomes a mathematical conversation when you stop viewing XRP as a coin and start viewing it as the liquidity provider for the $27 trillion problem. If XRP were to capture just 10% of the daily global settlement volume currently held by the legacy SWIFT system, the required liquidity on the ledger would necessitate a price point significantly higher than the current market valuations to avoid massive slippage, with some models suggesting a fair value floor above $500 per token. The truth about the price is that it is being programmed by the utility, not by retail demand. In the old world, price was driven by what someone else is willing to pay for it. In the new world, the world of the Great Reset, the price is driven by what the system needs to function. Now, if the global banking rails require a bridge to move trillions of dollars daily, well, that bridge must have a high enough value to carry the load. You cannot move $1 billion across a bridge that only has $1 million of liquidity. This is the liquidity-based valuation model that institutions are currently using to justify their massive entry points. A prominent financial analyst recently remarked that the price of XRP is irrelevant to the bank. What matters is the depth of the pool. Now, he stated that for the system to achieve its full potential, the price must reach a level where the daily circulating supply can settle the world's debt without causing a localized liquidity crisis. This brings us to the final verdict. We are moving towards a liquidity-induced supply shock. With the ETFs locking up the float, the banks integrating the rails, and the NDAs expiring, the available XRP on the open market is disappearing. We are no longer looking for a pump, we are looking for a repricing. And when the switch is finally flipped and the Nostro Vostro capital is liberated, the market will find its new equilibrium in a matter of seconds. Analysis of the global reset timeline suggests that the convergence of the ISO 20022 compliance and the full rollout of the Clarity Act in late 2026 will create a terminal point for legacy settlement. Projections indicate a 300% increase in network volatility and velocity as the final dominoes of the old financial system are retired. Looking at the evidence, I can't help but feel that the Great Reset is the most telegraphed event in financial history. The tools are ready, the laws are passed, and the money is in place. The only thing left is for the world to realize that the transition has already started. You are not waiting for the future, you are now living in it. Now, the question isn't whether XRP is ready for the reset, it's whether you are. For now, you can do me a favor by hitting that like button, subscribing to the channel, and checking the video that is queued up on the screen. I will catch you all in the next one.